These are a few examples of adjusting entries. Example 1. Company A pays Company B, an insurance firm, for a full year's insurance policy on January 1st, which costs $3,000. So Company A is the customer, and Company B is the insurance firm. So when the customer makes this $3,000 payment on January 1st, their initial journal entry on January 1st will be to record a debit to prepaid insurance and a credit to cash because they're paying cash. The reason that this is considered prepaid insurance is because they're prepaying upfront for an entire year's policy. So it's not actually insurance expense yet. It will become insurance expense month by month as they actually reap the benefit of the insurance policy on a monthly basis. So initially they record the $3,000 as prepaid insurance and as cash going out. So this is showing a prepaid expense from the customer side. So if a customer is prepaying something, that means that the insurance firm is receiving cash, but it's for a service they haven't fully provided yet. So they haven't earned this revenue yet. So the entry that they will make on January 1st is to debit cash, showing that they recorded cash, and then to credit unearned revenue. And that amount is $3,000. So then on a monthly basis, when the adjusting entries are prepared at the end of the month, on the customer side, they will then recognize 1 month of insurance expense. So the adjusting entry on January 31st for the customer would be to debit insurance expense since they have now incurred the expense, and then credit prepaid insurance. The reason they have to credit prepaid insurance is to reduce the balance in that account. So when they made the initial entry on January 1st, recording the $3,000 as prepaid insurance, that represented 12 months of prepaid insurance. But now at the end of January, they have used up one of those months. So now they're showing 1 month of insurance expense and then 11 months as prepaid insurance. So they record the monthly premium amount as being insurance expense. Then on the insurance firm side, when they prepare their adjusting entries at the end of the month, they will now have earned 1 month of revenue. So they will recognize 1 month of revenue, and then there will still be 11 months of unearned revenue. So to reduce the amount in the unearned revenue account, they have to debit unearned revenue and now that they've earned some revenue, they can credit revenue. And again, that will be for the amount of 1 month's policy. Example number 2. Company A newspaper publisher, receives the full payment for a 6-month newspaper subscription from Company B in the amount of $300. So in this case, it's Company B who is the customer, and Company A is the newspaper company. So Company A receives the full payment for a 6-month newspaper subscription in the amount of $300. So their initial entry when they received that payment on January 1st, of course they have to debit cash because they've received cash. but they can't credit revenue because they haven't actually earned the revenue yet, because they haven't provided 6 months of newspapers yet. So instead of recording revenue, they instead have to credit unearned revenue. And that amount is $300. So when the customer pays for a 6-month newspaper subscription on January 1st, on their side, they can't record it as subscription expense because they haven't actually incurred that expense yet. They've prepaid for the subscription. So they debit prepaid subscription, and they paid cash, so they credit cash, and that was $300. So then at the end of the first month of this subscription, Company A, the newspaper, they enter an adjusting entry. It's the end of the month, January 31st. And they have now fulfilled 1 month of their obligation for the subscription. So they've now earned 1 month of revenue. So in order to record that revenue, that's a credit to revenue. Therefore, the debit has to be to unearned revenue. Then the credit can be to revenue. And 1 month's amount would be $50, because if it's $300 for 6 months, then that equals $50 per month. Then on the customer side, when they record their adjusting entry to adjust the prepaid amount, at the beginning of the month, they were showing 6 months prepaid. But now that 1 month has taken place, they've already received 1 newspaper. They then record subscription expense for the first month. Then they have to reduce the amount of prepaid on the books, so they credit prepaid subscription. And that amount again is $50. Example 3. Company A hires Company B, an accounting firm, to prepare its annual tax return, and Company A will pay in February when the service is complete. The accountant charges $100 per hour and spent 5 hours on the tax return in January. So in the previous 2 examples, we were looking at prepaid expenses and unearned revenues. For the next 2 examples, we'll be looking at accrued expenses and accrued revenues. So in the first 2 examples, payment was taking place in advance. In these 2 examples, when things are accrued, that means that payment will take place later, but we have to go ahead and adjust the books to show the revenue that was earned or the expense that was incurred. So in this example, Company A is the customer. Company B is the accounting firm. So Company A hires Company B to prepare its annual tax return. Company A will not pay in advance. Company A will pay when the service is complete. The accountant charges $100 per hour and spent 5 hours on the tax return. So we know that in January, $500 of expense was incurred for the customer, and $500 of revenue was earned for the accountant, but no money has changed hands yet. So January 31st will be when both the customer and the accounting firm need to adjust their books to show the transaction that actually took place, but for which no money has been exchanged yet. So the adjusting entry for the customer company would be on January 31st. They realize that they need to accurately represent all their expenses for the month. And so one of those expenses was for tax preparation. Even though they haven't paid it yet, they need to show that expense is taking place. So they go ahead and record the expense. So we can call this accounting fees expense. They don't credit cash because they're not paying cash yet. So they record it as accounts payable because they will have to pay it in the future. And that amount is $500. Then from the accounting firm perspective on January 31st, they look at their books at the end of the month and realize that they need to accurately represent all the revenue that they earned during the month, even though they haven't received the cash yet. So they record accounts receivable instead of cash because they haven't received the cash, but they will be receiving it in the future. And since they have earned the revenue, they can credit a revenue account. So in this case, we can credit fees earned. That is the revenue account that service businesses use. And that's also for $500. So now, just as more of for your information, these are the adjusting entries. So that's what we're learning in the chapter is adjusting entries. But also I want you to understand the full picture of what happens when the cash is actually paid. So the customer pays on February 15th, we'll say. So they have previously recorded a credit to accounts payable showing that they have to pay this. Well, when they do pay it, they can get rid of that balance. So they debit accounts payable because they're now paying it. And they're paying out cash, so they credit cash. That's $500. Then from the accounting firm standpoint, on February 15th, when they receive that cash payment, obviously they will debit cash because they're receiving cash. Previously, they had recorded accounts receivable while they were waiting to receive the cash, but now that they've received it, they can zero that out. So they credit accounts receivable to reduce that balance. And that's the $500. Example 4, Company A, an architect, is designing a skyscraper for Company B. So Company B is the customer. Company A is the architect. The architect will collect payment in February once the blueprint is finished. So they're going to do work up front and then get the money later. The architect worked on the project for $100 in January at a rate of $200 per hour. So we already know that the total amount of the payment will be $20,000. So the architect and their customer have come to this agreement. So work is going to take place during January. Again, it won't be paid until February, like the previous example. So at the end of the month, the adjusting entry here for the architect, January 31st, they need to recognize the amount of revenue that they earned in January, even if they didn't get paid for it yet. So since they anticipate receiving that money later, they will debit accounts receivable and they will credit fees earned. Remember, that's the revenue account for a service business. And that amount is $20,000. So that's the revenue side. The expense side for the customer on January 31st, they need to record an expense to accurately reflect their expenses for the month, even though they haven't actually paid it in cash yet. So they need to debit an expense, which we can call architect fees expense. And they haven't paid the cash yet, but since they will be paying it in the future, they record accounts payable in the amount of $20,000. So again, just like example number 3, these are the actual adjusting entries, like what we're learning in this chapter. But just to give you a big picture idea of what actually happens when the cash does change hands, so we'll say that the payment is on February 15th. The architect receives the cash, so they debit cash and credit accounts receivable for $20,000. And then the customer, now that they're paying the cash on February 15th, remember that would be a credit to cash. So their debit will be to accounts payable now that they are paying this amount. Sorry, y'all, my pen for some reason is not working. This keeps happening. But anyway, so they will debit accounts payable and credit cash for $20,000.